This
Just go,
conference will now be recorded.
could simply carry on. Okay, so these are the three formulas, and you're expected to know those. Let's move into why we have a master budget process. And a major issue facing retail companies and the manufacturers who manufacture things for retail companies, as with you, is month-to-month liquidity. How do you ensure that you have enough money to pay your bills each month? And so companies face the same thing, corporations, especially when they have cyclical businesses where, most of the income is coming in late in the year. And that's true for a lot of companies. Most income comes in the last quarter of the year. So let's look at the starting point in the master budget process. And there's certain items we need. So we're looking at a simple retail case. A budget period, we'll be using quarterly. Selling price by quarter. Sales units by quarter. Collections by quarter. Total expenses by quarter. Payment of expenses by quarter. Beginning cash balance and desired ending cash balance. So if you are running a company, you got to have these assumptions. And so we made the assumptions that the sales were 20,000, 10,000, 10,000, and 160,000. So selling price 50, all sales in cash. Beginning cash balance and the minimum cash balance we want is $100,000. We're selling books that cost $20 each, so that's the variable cost. All purchases paid in cash. And the selling expenses, which are our fixed costs that are paid quarterly, is $1 million. So every quarter, you got to pay $1 million. And we said, what is this desired ending cash balance? So let's just see. So suppose we're in the first quarter. We're in the first quarter, and we said the number of units that were going to be sold in the first quarter is what? 20,000. Our selling price was what? $50 a book. So our total sales for this first quarter would be how much? That'd be $1 million.
$1 million.
Yes.
And we had a beginning cash balance of 100,000. And so your cash available was 1,100,000. Let's look at our disbursements. The books cost us $20 each. So if we sell 20, we got to buy 20. So what's the cost of the books going to be?
$400,000.
And the selling expenses are a fixed what? $1 million. So your total expenses for this first quarter is $1.4 million. But you only got $1 million. And so you have a negative 300,000 cash position. You got a negative 300,000 cash position. So you need to borrow some money. And if your ending cash is supposed to be 100,000, then how much do you need to borrow?
40,000.
Now, if a business does not recognize this ahead of time and make plans for a line of credit with the bank. If it gets into the situation, the bank's not going to loan, possibly will not loan them the money. So when you see businesses and malls, etc., with paper up and the business is gone, if you don't pay that rent in that mall, you got to go. In any warehouse, anywhere, just like in your apartment or your house. If you don't pay the rent, you got to go. So when you're running a business, it's the same thing. And so you look at this and then you make plans. Now in the second quarter, we said they were selling what? 10,000. Still at 50. So what's the sales in the second quarter going to be?
500,000.
500.
I have a question. What is loan repayment? Why do we have that line down here if we ain't gonna put nothing down there?
Eventually we are, but we are in a borrowing situation now. We're hoping to be in a loan repayment situation in quarter four.
Okay.
Beginning cash, we bring up what's down here, 100,000. And so now we have available 600,000. Our cost of the books, we had to buy 10,000 at 20. So what's the cost of our books going to be?
200,000.
200,000. You still got to pay that $1 million. And so now our total expenditures are what?
1,200,000.
1,200,000. But you only got how much available?
600,000.
So what you got to do?
So would that be a negative 600,000 then?
That's a negative 600,000. How much you got to borrow? If you want 100,000 here, how much you got to borrow?
700.
700,000. All right, you all do quarter three. Take a couple of minutes and do quarter three.
Is quarter three not the exact same as quarter two?
Yeah, that's what I'm.
10,000 sold. Selling price 50. Sales 500. Beginning cash is 100. And so we had available 600. We got to buy those 200,000 in books again. Our selling expenses are still $1 million. And so our total expenses are $1.2 million. And therefore we're down what? -6 again. So how much we got to borrow? We want 100,000 here.
700,000. 700,000.
All right, so now, Kayla, you can do that fourth quarter and pay that loan back. And how many units did we say we were selling in the fourth quarter? 160,000, correct? So this is what a lot of retail businesses wait for. You hear on the news, whether they're going to make a profit or loss depends on the holiday season, the Christmas season. This is how a lot of businesses operate, and they have to make that money in the last quarter. So what's our sales going to be in this last quarter?
8 million.
And the beginning cash is how much?
100,000.
So then 8,100,000 is what we have available. What's the cost of the books going to be?
3,200,000.
How much?
3,200,000.
Okay. And so our selling expenses stay the same.
So we got 4,200,000.
Expenses. So what's our excess cash now?
3,900,000.
Say 3,900,000.
Yeah.
Now we're going to, guess I got an extra zero in here. 3 million. So how much did we borrow?
1,800,000.
So the bank will expect us to pay them back.
So wait, so in quarter four, we just adding up all the borrowings from the other 3 quarters, right? Because we don't have to borrow no more.
I got down the wrong line. Let's see. So now we're going to come here and pay it back. And so how much cash do we have now after we pay them back?
2,100,000.
So we got 2,100,000, and if we did an income statement, our sales would have been what? 10 million, correct? So our sales would have been 10 million. Our cost of goods sold, we add all of these up, 4 million. So our contribution margin on a dollar basis was what, 6 million. Our rent expense, we said, was 4 million also. So we had a net income of $2 million. But if you had not made this analysis, taking it to the bank, showing when you're going to need to borrow, showing your income at the end and that you could pay back, you wouldn't get to this point. You would not get to this point.
So wait, so ending cash is 2,100,000, but the net income is 2 million. Is that
Why?
like kind of
Why?
understand what's going on here?
Why? Why is 100,000 difference?
Because you
Oh, that was the
started
starting
with
balance, right?
100,000 in
Thank you.
cash.
You started with 100,000.
Okay.
So the income is our excess over what we started with. What's my break-even sales in this example? So looking at this, if I told you to calculate the break-even sales, what would that be?
Are we breaking even now?
No, you made 2 million.
Oh,
So I
well,
want to know the quantity to sell.
8 million.
8 million.
This to break even. This if the income right now is 2 million.
The quantity.
Oh, the quantity.
The quantity you got to sell to break even.
Oh, okay, hold on.
So you should be seeing some things about break even. What quantity you got to sell to break even? Now see what happened to
You'd have to sell 50,000.
how did you get 50,000?
I just plugged the numbers into the formula. Well, that could be wrong actually. Now that I think about it, but it's close to 50,000.
How you say close to 50,000?
Yeah.
Well, that's gonna go in my formula here. What's gonna go on the other side of my formula? What's gonna go in here?
$6 million.
Well, not quite 6 million. Because remember, I told you last time, everything was on what? A unit basis. So the selling price was 50. I'm not gonna let me do anything now. Got out of my formula. The selling price was 50. That's why I tell you I always work thing for one. And the cost of goods sold for one item was what? 20. So your contribution margin is what? What is your contribution margin?
That'd be 30.
Thank you. So let's see if we can put this in a formula now to get our break even. The break even is going to equal what? These rent expenses, this fixed cost, slash what? That contribution margin. So why do y'all have that number? I don't think anybody said that. So I told you to learn those formulas, and then I told you to get your Excel sheet and put that formula in there so you could calculate it. All right, what's the target profit of $1 million going to be? How many we got to sell so that the target profit is $1 million? How many we got to sell so the target profit is $1 million?
so it'd be $1 million plus the contribution margin, right? And then divided by the fixed cost.
Kayla.
It would be 166,666.
So we're going to get this fixed
Did you
cost.
get a confirm to what I was saying?
Yeah, it's just what Kayla said.
There.
Yeah,
she was right. It's 1 million to the 4 million. You get 5 million, and you divide that by 30, and you get the number that you
Okay.
just said.
Yeah.
A little stressed out for a second. Help.
No, it was the same
Dang.
thing. That's why I was like,
That what you got?
yes.
Okay. I didn't hear it, Kelly. So can we work a little problem like this? So all the major retail companies in Houston who get off most of that money the last quarter, they're doing this every year so they can borrow. You can remember a couple of years ago, there's a question was going to happen. The banks didn't have the money to loan companies. What was going to happen to the retail segment? But then the wholesalers who sell to these people, they're operating the same way. So this is the analysis that they're making. So the manufacturers, excuse me, who are selling. Okay. So let's move to a manufacturing company since you all are making something, since you all demand to make a product. And let's look at the master budget process for a manufacturing company. So it's going to be a little more involved. You got a sales budget, you got a production budget, and an ending inventory budget. You got a selling and administrative expense budget. You got direct materials, direct labor, manufacturing overhead, and all of those things leads you
You gonna
to
get to this eventually.
the cash budget that we just prepared, but it's a little more complicated, and also a budgeted income statement that we just calculated and a budgeted balance sheet. So what we're going to do is we're going to work with each of these schedules. We're going to work with each of these schedules. And the schedules in general tell us two things. Number one, it gives us the dollar amount to go into some journal entries. Then it gives us at the bottom of those schedules the cash amount that goes into the cash budget. And of course, we know if we make journal entries and post them to the ledger and do a trial balance, we can what? We can prepare a balance sheet and an income statement. We're just doing budgeted ones now, but they're going to tie to that cash budget because we use the same schedule for both. So what we're trying to do is to come up with a way where there is a tie-in between that cash budget we just did and the financial statements we prepare. And so we have this process that we've developed to do that. Okay, so, and of course, all of you were assigned one of these budgets. So you should pay attention, especially when we're talking about your budget. So you have here a discussion of the budget that you were given, several things. Then I got the journal entries already here made. Okay, I'm showing you what the journal entries are gonna be that are made with the sales budget. With the production budget, there are no journal entries. But the results from the production budget go to the raw materials budget. And they've got two journal entries. Those numbers also go to the labor budget. They've got one journal entry. There's a manufacturing overhead budget, which is independent since it's a fixed cost. It has a journal entry. Selling expenses has a journal entry, one journal entry. And the amounts for the selling expense comes from the sales budget. Administrative expenses has a journal entry. And then the capital budget, where you buy the equipment and then you make payments on interest and expense. So they got a budget and they got their journal entries. Then the cash budget, when we borrow money, we got to make a journal entry to receive the short-term loan. Then when we pay it back, we got to make a journal entry. So we're making journal entries, and this turns out to be less than 20 journal entries. This turns out to be less than 20 journal entries. So let's look at our assumptions. And we've got quarterly sales of 10, 20%, 30%, 40%. Our selling price, you told us 500. You're collecting 40% in the month of sale, 50% the month after sale. You got a desired inventory of 50% of next month's sale. Your raw materials, ink, 5 ink cartridges at 10. Your paper, 7 reams at $7 each. And this is how you're paying for your raw materials. Your direct labor is 20 books at $20 an hour. Your manufacturing overhead here is quarterly, so you get a total amount, but this is the quarterly amounts and the depreciation in it. And the key thing here is that when you're looking at what the cash you got to pay, you're only concerned within the cash budget, the dollars. You aren't paying depreciation, so you wouldn't prepare a budget saying I'm paying overhead of $25,000 and only $15,000. Our selling expenses are 30% of sales, and that's paid quarterly. Then we have our administrative expenses with that depreciation and a similar thing. Our initial investment is $200,000. Our minimum cash required is $1 million. We bought $1 million in equipment, and we pay back $25,000 in interest and $100,000 in principal each quarter. So those are our assumptions, and it's just a matter of you picking out your part of the assumption. So what is it, team 8? Is it team 8 that has the master budget quantity solutions? Is that
Yeah.
right? Okay.
It's the right one.
Y'all already finished?
No.
All right, selling price is what?
500.
500. And you'll be doing both years, but we'll put that in. How much is the ink?
I'm not sure. Can you scroll up, please?
It says the ink was what? 5 ink cartridges at $10 each.
So it'll be 50.
Okay, so it'll be 50. Now, I'm not going to do all of it for you, but you got to get your money and get it to the salespeople and everybody else. What's your bad debt expense going to be? All right, if I'm collecting 40% and 50%, then my bad debt must be 10%. Okay, so if I'm collecting 90% of it, then 10% of the people are not paying. And so that's 50. So you got to go through here now, get your contribution margin, and then put those total expenses in for the year, add them up, total fixed costs, and come up with a quantity. Okay. And you will send that on to the sales team and everybody else. But let's just assume, sales team, that they come up with $10,000. Okay. So they come up with $10,000. So what you're going to do, sales team, What team is that? That team. You're going to take the 10,000 and put it right here. So whatever quantity that we have, whatever quantity that we come up with in our first year where the target loss is 100,000, when we get the quantity, we bring that quantity right here to the sales quantity. Now I'll go up here and see if I can pull these down. And I'm going to put those in here. And so now I'm going to allocate those sales, that 10,000, based on my quarterly percents. So 10% of the 10,000 are what? 1,000 in quarter one. How many in quarter two? 2,000. How many in quarter three?
3,000.
And how many in quarter four?
4,000.
4,000.
So does everybody see what we did? We went up here and we calculated that for a target loss of 100,000, the quantity would be 10,000. Now they got to get the extra number in it. Maybe to come out to 10,000, I don't know. But I'm assuming they get 10,000. Then you bring that 10,000 salespeople and you put it right here. Okay. Then you allocate it based on these percentages. Then you multiply, and what's your selling price in this case? Wasn't it 500?
Yes.
So we're going to take the 500 and we're going to multiply that times the total sales. So how much is that going to be? What's 500 times 1,000? Is that 500,000 maybe?
Yes.
And to make things simple, we're going to keep all the sales credit. Now, let me see if I can show you something else here before we move down. So let me just see if I can copy this. Okay, so I'm going to put that in here. And I'm going to take all of these out. And I'm going to put collections right here. And we'll make this August. And we'll make this September. And we'll make this October. So Tyler, suppose that your tuition was $10,000. So in August, Texas Southern charged you $10,000 for your tuition. And you paid 50% down and then you paid 25% in September and 25% in October. So what is TSU's collections going to look like?
For August or for the other 2 months?
Each month. What's it going to be in August?
You said 50% for August?
Mm-hmm.
So 5,000.
Wrong line. And the next month, how much they're going to collect?
2,000.
Maybe a little bit more than that.
What was the percentage?
25%.
Oh, it'd be 2,500.
And October, the second month after they make the sale to you, how much they going to collect?
And what was that one percentage?
Another 25%.
Oh, 2,500.
Okay. Does everyone understand that example? That from TSU standpoint, they made a sale to you of $10,000, and they collected $5,000 in August. Then the next month after the sale, they got $2,500. The second month after the sale, they got $2,500. Does everybody understand that? Okay. So when you have your sales of 5,500,000, 10% of the people not paying. So we got 50,000 in here. So they're not paying. Then you collecting 40% in the month of sales. So what's 40% of 5 million?
200,000.
200,000. And then when you gonna get that other 50%?
So 250,000.
When you gonna get the 250?
After the first month.
So what column am I gonna be in?
2.
Column 2. All right.
Wait,
So
but if you're getting the 250,000 after the first month, ain't the first month still in the first quarter?
I use months here. We on quarters now.
Yeah, well, that don't make sense.
I'm switching to quarters now. I just did this to give a simple example. But all our problems are based on quarter. And
So it's
got a
sorry.
good
So
point. This should be
collections.
quarter.
Okay.
That should be quarter there. Thank you. Okay. So these are the quarters. So does everyone see that now? We had sales of 500,000. 50,000 we not gonna get. We put that right here. Then we're going to collect 200,000 in this first quarter. The other 250 we get the next quarter. All right, let's do one more, Tyler. We go to the second quarter. And so selling price still 500. So what's our total sales gonna be now?
$1 million.
And they're all credit sales. Because if they're not all credit sales, that would impact our unit costs and our quantities. So 10% of these people not gonna pay. How much of the 1 million you gonna collect?
400,000.
Then when you gonna get the other 500,000?
And quarter 3.
Okay. So do you see how it's sliding? Everybody see how it's sliding? as you work on your sales journal in terms of how much cash you're getting. Okay? So, in the first quarter, I don't have my auto sum here. I should have been in Excel. It was 200,000. And the next quarter, 650. So for our company in this situation, this shows what those collections are going to be. Now, once you get all your sales in, I'm gonna put a JE here. That means you gotta make a journal entry here. And then when you get all your, then with these bad debts, you got to make a journal entry. And of course, you know that when you always sell something, I'm gonna put in parentheses, always two journal entries involved when you're selling something. What are those journal entries when you sell a product? From your inventory account.
Cost of goods sold.
You got sales and you got cost of goods sold. Okay, so you're gonna have a journal entry here for all your collections. So once you total them out, you will make your journal entry. And then for these collections, if we go way down the road to the cash budget, these collections are going to show up right here. Why do you want to do that? How much are those cash collections? I tell you, how much was cash collection in the first quarter? Well, all of them jumped in there. Does anybody have it there? Let me go back up here again. All I wanted was these two bottom numbers. Let me see if they'll come this time. 200,000 and 650,000. Maybe something is happening when I'm scrolling. They came that time. Our beginning cash was how much? We had 200,000, right? So our cash available at the end of the first quarter is 400,000. So the sales journal gives us how much cash we have. You have to go through all the way and do that. Then for our disbursements, everybody else, raw materials, ink, gotta tell me how much is being paid, paper, labor, overhead, selling expenses, administrative expenses, long-term note, interest, total payments. So we can see whether we have an excess cash or not, and whether we need to borrow a short-term loan. And we know that this number has to be 100,000 at a minimum. Okay, time for the production budget. Team 4, y'all ready? Good, they're ready. On the production budget, we're gonna come here and lift this quantity line. And that's gonna be the first thing on this line. Okay, the first thing, the first line of the production budget comes from the first line of the sales budget, whose total 10,000 comes from what? Our quantity solution calculation. So we do need our quantity solution calculation correct, teammate. Y'all got it calculated yet for us? They don't have it calculated yet. All right, let's do this production budget. It says that our desired ending inventory is 50% of next month's sales. So not only do you got to produce what you selling when we sell in the bookshelves, but you also got to produce half of these items. So when the first quarter comes in, you have some inventory available. So you got to produce 1,000 you're selling in 50% of these. So this is 1,000. So the total needed is 2,000. That's what you got to produce. You don't have any beginning inventory. So the unit to be produced is 2,000. Let's go to the second quarter. We sell in 2,000, so we got to produce 2,000. But what's going to be in this column, Kayla?
1,500.
Ah, see that? I knew you'd get it. So the total needed is 3,500. Less beginning inventory. Well, we got a beginning inventory over here of 1,000, so that comes over. So 2,500 becomes what you're going to
Where'd you
produce.
get that beginning inventory number from?
Because you produced it the first quarter. You produced it. You produced what you sold, 1,000, but you produced 2,000. So your ending inventory for the first quarter becomes your beginning inventory for the next quarter. Let's think about that. Think about it a little bit. Now, once the production budget finishes, and I'm sure there will be finished before the day is out, assuming the sales budget people have their first row done, assuming the assumption people have their first row done, well, whatever is on this units to be produced line is going to come right here.
Oh, you don't want to finish the production budget real quick?
That's what y'all gonna do. That's why I didn't finish the sales budget. Then raw materials, paper. I give you something to do there. You should have it finished by the time I finish explaining things to other people. So for each of these production budgets, their starting point comes from the production budget. So production doesn't have any journal entries or dollars, or nothing. These are just quantities. But raw materials, ink, and raw materials, paper, and direct labor, they gotta come in here. Who has direct labor? Was that team here? Well, I was gonna help them out a little bit, but I guess they're not here. Okay. They make 20 books per hour and they're paid $20 an hour. So they can make 20 per hour. We just put 20 per hour in here. I know when you work in Excel, you can't have these letters in here, but we just put the 20 per hour in here. So how many hours are they gonna have to work to make 2,000 books?
$100.
100 hours.
I mean, what's the labor rate? $20 an hour. So the workers are gonna be paid how much this first quarter?
2,000.
$2,000. So all you have to do is take this on across. Once the production budget tell you your amount, and you would take that $2,000 though, eventually when I ask you tomorrow, and you're gonna say direct labor, 2,000, that goes right here. Do I have a raw materials person in here?
Oh, yeah.
Okay, so let's just do the first one, the ink. So what's the per unit requirement on ink?
Uh, it's 10 per unit.
So each book requires 10 ink. Why did it do that? Go back, get back into ink. Sometimes there are disadvantages to working in Word. And I expect we're gonna be in Excel tomorrow. So ink is per unit requirement 10. So how many ink cartridges are you gonna need?
Ink is 5 per unit.
How many? Is it 5?
It's 5, yeah, 5 per book.
Okay. So you're gonna need how many ink cartridges?
2,000 times 5 is 10,000.
1,000.
Mhm.
What's the unit cost of the ink?
$10 per unit.
That's
So
cost
it's,
1,000 unit.
yes,
So
20,000.
how much?
20,000.
I get 20,000. You got ink 10,000 ink cartridges.
Oh,
10.
10,000. Oh, it's 100,000.
Now, how do you pay for these ink cartridges? You pay based on these assumptions. 75% in the month of, so this should be month of purchase. And this should be the month of purchase too. So when you buy it, you're only paying 75% in that quarter. So if you're paying 75%, how much are you gonna pay that quarter?
75,000.
Okay. And then when you gonna pay the other? And it says month, but these are all quarters.
In the second quarter.
Pay the 25,000 in the second quarter. So you think you can finish these out now?
Yes.
See, I knew we'd be able to handle this by Thursday. So he's ready for it. So the total payment is 75,000. And tomorrow, when Kayla's doing this, she's gonna tell you to Give me all of these numbers going across.
Best boy, stop doing that. Kayla is not doing nothing more than what Kayla got to do. Please stop doing that.
Just joking. Just all right. So 75,000 goes here. Okay, so we got the ink. We're gonna do the same thing with the paper. Let's look at manufacturing overhead. And so with the manufacturing overhead, we get to our assumptions. The manufacturing overhead is 25,000 a quarter. Depreciation is 10,000. So we simply are going to, with the manufacturing overhead, we're going to put total overhead 25,000. That depreciation was 10,000, correct? We're going to put the total payment here of 15,000. And that's going to stay the same all the way across because these are fixed costs. But the payment is 15,000. And so the payment for the manufacturing overhead is 15,000. Administrative expense is going to work the same way. So with the administrative expense, 50,000, 10 of it's depreciation, so you only got to pay 40. So we're going to take the 50,000 to depreciation was 10,000, correct? So the payment is 40,000. That will operate exactly like that all the way across. And so the administrative expenses we're paying are 40,000. 15, 10. Okay. The selling expenses were 30% of the sales quarterly. So we come in here and pick up these sales, whatever these numbers are. So just change this to sales on your template. So you have the sales in this. And our rate was 30%. That is, the commission rate was 30%. So you simply take 30% of each number, says these sales are coming in. So the commissions are going to be 150,000. Here you take 30%, 300,000. And sometimes we might have depreciation in numbers that we don't, so we're not assuming that. So it's just a total number. So for 150 and 300,000, they're going to come in here. 150,003. and I'll put the 300,000. So we're coming through using those schedules to determine what our cash expenditures are. And so when we had depreciation, we subtracted it out in these numbers here. So now we just need the long-term note. So on the capital expenditure budget, in our assumptions, we bought $1 million in equipment using just the note, so we didn't pay anything down. And our interest and principal are $25,000. Are these what these are? Interest and principal? Hopefully they're the right way. Now, when you bought the equipment, it was $1 million, but we use a long-term note. And if you had a down payment, you'd have a cash impact, but you're not going to have a cash impact. So you're just showing that. Now you do have your journal entries that go here. But we're going to copy these. Okay, so now our cash available is $400,000. So if we add all of these numbers up, and we're just doing the first quarter, what is our expenditure for the first quarter? If we add all these numbers up. If someone add these up. That 407,000. Let's assume it's 407,000. Okay, how much cash did we have? 400. Our expenditures are 487. So we're in a minus 7,000 position. So we need a short-term loan. How much do we need the short-term loan for? How much might we need a short-term loan for?
7,000.
How much?
7,000.
No.
Is it like 500 and 7,000 or 514,000?
No.
Would it be 8?
No.
I don't get it. If you want $100,000 back, I thought it would be like 500 and something.
Did you ask for how long we would want that loan for?
We are down 7,000. So our receipts, we got available 400. Our expenditures are going to be 407, and we want this number to be 100,000. So how much do we need to borrow?
107,000.
Thank you. And that's it. That's the first column. So what you want to do see. And I think you have this to be in Excel. And if you're in Excel as you're working and put your formulas in, and of course you can write your formulas, especially since we're on the same page, to drop all those numbers down here. So every time you put in something on this last line, it can flow into here as you're working with it. So in general, you're doing your schedule, but you know at the end of the day, you got to be able to do all of this. So quite honestly, everybody should be in here getting these assumptions and getting these target loss amount and break even amount. Then as you're working for your project,
I
you're
have
going
a question about the
to
project
that.
whenever you're done.
Beg pardon? What did you say?
I said a question about the project whenever you're done explaining the master budget.
Okay.
Can you not hear
So
me?
what we just did is what you're doing on the project. So the exact thing that we did, that's what you're doing on the project. And if you use Excel and put your formulas in, the first year will take some time, but with your formulas in and everything, you should be able to run through your next years pretty easily. So when we do the project,
Professor Boyd, can you hear me
we're doing a cash budget for the first year, and all of this for the first year. When you lose 100,000, what does all of this look like? Then when you break even, what does this look like? And when you make $1 million, what does your cash situation look like?